Hey everyone, welcome and thanks for joining today. For those of you who attend in the past, you're probably not familiar with who's speaking here, but I am Pete from DeFi Development Corp. Our IR guy DK will be sitting out and I'll be hosting this time around. Nonetheless, we're super excited to host a conversation on Solana lending today, what it unlocks, why it matters to both everyday DeFi users and institutional capital. We're super excited. We're joined today with our partners at Kamino. For those of you who don't know, it's the leading lending protocol on Solana. And of course, we've got Joseph and Parker from DFDV, which I'm sure everyone here knows. So we'll start with the basics, how lending works, what makes Solana different, and then we'll go a little bit deeper into the ecosystem and what the future of protocol public company integrations could look like. So lots to dig in today. Before we dive in, a quick note, today's conversations may include forward-looking statements. Those involve risks and uncertainties that could cause actual results to differ materially. For a fuller discussion of those risks, please refer to our most recent Form 8K filed and other filings with the SEC. We don't undertake any obligation to update these forward-looking statements. All right, Mark, how you doing? GM.
GM, hello from sunny Switzerland.
Sunny Switzerland, love it, love it. Cool. Well, yeah, this is going to be, 30, 45 minutes. Again, we really appreciate you coming up. We're super pleased to have partnered with you guys recently. Of course, we'll get to that in the chats. But, first and foremost, let's dig right into lending 101. To kick things off for folks who are newer to DeFi, do you mind just kind of telling us what makes borrowing and lending in crypto fundamentally different from traditional finance? And then maybe too, if you want to add on to that, what makes Solana unique for lending protocols? Obviously, Kamino has been building on Solana for quite some time, so you guys have a interesting perspective.
Yeah, sure. So happy to chat on that. And actually, it's a good line of questioning because often we're straight into the weeds with really complex stuff and new products, but actually talking about the lending 101 is pretty interesting. And I was thinking that when you asked about crypto lending and how it differs from lending in the real world as such, or traditional finance, and it's not that different in many ways, but actually it's very different in others. So I'll talk a little bit about where I see the similarities and differences. Now, a big difference with crypto, and let's say DeFi actually rather than crypto, is how fundamentally people on the street are thinking about taking loans. Now, if you're on let's just say you want to take a loan, right? And in the real world, the first place you're generally going to go is your bank, right? And say, hey, I need 10K, I need 5K, I want to buy a car, I want to go on holiday. And they will, depending on the country and how efficient it is, the bank will have loads of details on you, right? So how much you earn, your spending habits, and your credit score, and they'll put some numbers in, maybe fill out some forms with you. Depending on the country, how backward it is, there might be paper forms posting things, so it might take a couple of weeks or it might be instant. But in essence, then they'll loan you some money. And that is a transaction between this kind of lending entity and you. But many people are used to getting loans that way, which is fine if you've got a good job and you've got a good credit score and stuff. But it's all dependent on who you are as a person. Now, let's take that into DeFi. What you're able to do in Kamino is still take a loan, but firstly, it's not from a company, it's not from a bank. You're actually taking that loan from the community of other users who are coming to earn interest as a lender. So Kamino and DeFi is facilitating peer-to-peer loan transactions. But then because Well, interacting with DeFi, I mean, Kamino blocks certain jurisdictions and still does like sanctioned wallet checks and so on. But broadly, anybody can use Kamino, but we don't know who the borrowers are, so you can't do a credit check. And then what the borrowers are doing, they're bringing some kind of security or what we could call collateral. They're bringing that to the picture so they can take a loan. And a main example of that, what's supported on Kamino and what's one of the big trades is borrowing dollars, so borrowing stable coins, and then using SOL or a SOL-based LST as the collateral. So it's like, hey, well, I have 50,000 worth of SOL, so I'll bring that to Kamino and deposit it there and keep my exposure. But I can take now a $20,000 loan, and I don't have to fill in forms. I don't have to tell anybody who I am or what I'm earning or my social security number or shoe size just to get a loan. So I think unpacking that's a big difference. So community sourced loans, not based on the individual and all kinds of personal details taken on you. So anything you want to unpack there?
Well, it's good to know that Kamino's not checking shoe size for one, but the others, of course, are nice too. Yeah, no, love it. I mean, it's the peer-to-peer lending industry has been big and continues to grow for quite some time, and obviously, the total addressable market, if you will, of banking is massive, and it's great. In my personal opinion, for the first time ever with DeFi, we're seeing technology really kind of come in and disrupt an industry that has long been undisruptable, if you will. It's in many ways, it seems like finance is the last to be disrupted by tech, maybe with the exception of healthcare, but totally makes sense. Just following up on that, can you help set the stage for why Solana is unique as it relates to lending protocols? Obviously, the birth of DeFi took place on Ethereum, but I think you could argue that a lot of the innovation in the industry or in the vertical has been thanks to Solana. So maybe you could just speak on what makes Solana unique in that regards.
Yeah. So basically, the reason why we're on Solana and still committed to Solana as Kamino is that if you're building financial infrastructure, and we've been building a marketplace, right? Marketplace for credit and peer-to-peer borrowing and lending. You need to be where the action is. So that means you need to be where people are doing business. And in the on-chain economy and the blockchain economy, you need to be where the tokens are. So we need to be where there's lots of tokens that people want to borrow and lots of tokens that people hold as collateral and hold as value. So as Solana and SOL has become increasingly popular, there's lots of people holding SOL, and there's lots of people who've had growth in wealth from holding SOL, and now they've got these valuable positions that they can collateralize. And we've got Solana as being a big place for new types of assets to be traded, these real world assets. So tokenized stocks, tokenized funds, and even I could call it tokenized Bitcoin, right? Like the wrapped Bitcoin that's actually coming to be traded in different blockchains because no one wants to use the Bitcoin network. And Solana is by far the biggest growth, let's say, playground for where all these tokens are. So then it's natural that the DeFi protocols, which are serving this token economy, are thriving on Solana, basically.
Right. Yeah, I mean, you said it best yourself. Go where the action is, and I think on both sides of the barbell in crypto, we're certainly seeing that take place here on Solana. Right, we've got obviously on one side meme coins, and then on the other side, the tokenization of real world assets. So Of
Yeah,
course,
yeah. I
makes
mean, if you
sense.
want to, yeah, exactly. If you want to, I don't know, go swimming, then you wouldn't go to a desert, right? So if you want to get involved in doing interesting stuff with tokens, you need to go where all the tokens are.
Totally. Though I'm sure there's people on crypto Twitter who would argue with you on that, but that's a whole other conversation for another day.
Sure,
Um,
sure. I mean, yeah, people obviously have their preferences, but I think if you objectively look at on-chain activity through, as you said, like meme coins, through to interesting deep in projects, crypto native assets, uh, through to like the tokenized off-chain assets, then yeah, Solana's been a hive of activity. Of course, it's not the only one, and there's a lot of wealth still sat on Ethereum. We've seen interesting stuff happening on, especially Base, but yeah, we're not blind maxis, but we're bullish on Solana.
Totally hear you. Yeah, I can't blame you. Yeah, that said, obviously a lot to do in the ecosystem. But maybe you can help listeners understand a little bit about how some of those things are done. So I guess I mean by that is maybe you could break it down for us a little bit further. When someone deposits in the Kamino, help us kind of understand what exactly is happening under the hood.
Yeah, sure. So, well, I mean, broadly, as I said, Camino's just a piece of infrastructure, right, that enables the marketplace to happen. So we broadly need two parties to be involved, right, the borrowers and the lenders. Now, the cool thing is that in the Camino smart contract, you could imagine what's happening under the hood is you've got different pools of assets. So let's take the example. There's of again someone with Sol and they want to borrow stable coins. You've got a bunch of lenders who want to come and earn their yield on stables. So they've deposited into a pool of stable coins, USDC, let's say. And then those who have Sol come and deposit into a pool of Sol. And that means that they now are able to borrow because they have this like collateral position that allows them to take credit. Now the cool thing is that this bucket of Sol, this pool of Sol that borrowers have brought for their collateral, that in itself is also borrowable. So a very cool thing that's been happening lately is that we've listed a new LST, for example, the DFDV SOL from DeFi Dev Corp and Sanctum. And now holders of this token are also able to come to Kamino and they can actually borrow against it, but they could borrow the SOL that others have deposited. And many users have been doing that in order to lever up the staking yield, which is available from DFDV SOL. So actually, with this flexible, you could call it like a pool-based setup, we've got little economies growing and thriving around these pools of assets. Now, first and foremost, risk management is key. So there's lots of configurations under the hood to keep all the users safe. But yeah, broadly, this is really how the marketplace is in operation with tens of thousands of users daily and around 4 billion worth of assets floating around in these pools. So that's like a quick TLDR on what's under the hood. And yeah, so a bunch of assets in pools, borrowers meeting lenders in different ways, and then the protocol stepping in to keep users safe. So, for example, liquidating positions before there's a risk of bad debts and so on, because all of these assets can also be volatile. Yeah, so I hope that
Right.
helps understand a bit.
Yeah, definitely. And it kind of leads me into like one of the next things that I think would be like good to just kind of hit on. I think amongst other things, one of the cool innovations that Kamino has brought forth and kind of stands out to is in terms of managing risk. So maybe if you wouldn't mind, like also just kind of quickly diving into how does like the borrow lend engine manage risk for users?
Yeah. So let's think about this. I always like to think of like the real world equivalents. So if you've got a mortgage, right, from your bank, you've got an asset which is your house, and then you've got an open loan which is your mortgage, and the value of your house should generally always be higher than the amount of debt that you have. If we get in these scenarios where there's a crash in house values, then what's going to happen? Let's say your house goes from being valued at $1 million to 700,000, but your debt is 700,000. Your bank is going to write you a letter saying, maybe it would start saying, "Hey, how's it going? Your valuations come down. Please, can you pay down some of your loan?" And if you ignore it, then the letters will get a bit more frequent and a bit less friendly. And if you do nothing, then after 6 months or a year, then there'll be some knocks at the door and you'll get kicked out of your house, right? And the bank's going to repossess it. But this is happening over the course of all this time. Now, we do exactly the same thing, or we've built for Kamino the same kind of thing, but all of this happens on chain and with immediate action when those loans become unhealthy. So instead of a house, you've got SOL, and instead of your mortgage debt in US dollars, you've got a USDC debt. Now, if the value of SOL goes down, Kamino's not going to write you a letter. It's actually going to move your loan position, which is freely available to see on the blockchain, into an unhealthy state, and then liquidators can come in and pay down your debt and claim some of your collateral to put the loan position healthy again. And that's actually something, these liquidators, they're not like owned by Kamino. It's actually open to anybody to come in and do that. So that's one of the measures that keeps users safe. And in order to kind of calculate all of the parameters and settings and loan restrictions and scale and caps, we've got a ton of stuff going on under the hood, which is all based on risk modeling. We've got some really great guys, much cleverer than me, crunching the numbers on this. And we share a lot of that actually on risk.kamino.finance. So if you like geeking out on numbers, looking at assets and liquidity and so on, then go and take a look. But yeah, that's also what's happening.
Good to know. Good to know. Yeah, I mean, crypto is great, DeFi is great. Of course, it's got its risks, so it's even better when you're using a platform where you've got a team of smart, capable individuals that are doing everything they can to make sure risk is managed correctly and users can know what to expect and there's no surprises. So great. Thank you for providing that clarity. You did mention something earlier too that maybe I'd just like to quickly shift gears. DFDV SOL, a new LST from DeFi Dev Corp that was launched with Sanctum or adopted from Sanctum. Kamino recently announced the integration of that. So maybe this is a good opportunity for Parker, if you don't mind. Maybe you can just kind of walk us a little bit through more on DFDV SOL, why it matters and what it really unlocks for users, particularly users on Kamino too.
Sure. I guess first off, Mark, thanks for joining. Really appreciate you coming on with us. So DFDV SOL, it's a Sanctum built LST. It's a very standard Sanctum LST, pointing at one of our validators, our main DFDV validator, and users can, basically stake to our validator via the LST. It's standard stuff, nothing too crazy there. And then you can, of course, use that as a liquid version of staked SOL throughout the DeFi ecosystem. So you can sell it if you don't want to, unstake. You can, of course, use it as collateral on Kamino to borrow other assets. There's, a whole bunch of other things you can do with it. So it behaves just like, say regular SOL or like any of the other LSTs out there. If you're trying to compare LSTs, I guess I would say, you've got the big general purpose LSTs, like a Jito or something. From a performance standpoint, those actually are going to typically underperform single validator LSTs because there's rebalancing in there. So Jito has to rebalance. They have to kick out poor performers. They have to add new validators. And so that rebalance comes with a cost, right? Every time there's a rebalance, there's a 2 epoch lag where, let's say you're rebalancing 2% of the stake every 10 epochs. Then, that's going to be actually, let's say it's every 2 epochs to make this easy. If you're rebalancing 2% of the stake every 2 epochs, that's actually like akin to a 2% fee because that is continuous 2% drag. So I guess if it was 10, then it'd be, 2% divided by 5. But I think Jito's like rebalancing 5 to 10% every cycle, every 10 epochs, right? And so that's a drag on performance. And so the single validator LSTs, as long as you think that the validator is going to be trustworthy, that they're not going to like go offline or they're not going to just randomly jack their fees up or something, the single validator LST is actually the best performing LST that you can get. So then what you're doing as an individual is you're evaluating, hey, which validator do I want to basically have an LST of? We think ours is pretty good. Obviously, we stake to our own and we have responsibilities to shareholders and auditors and everyone to answer to if we have, issues, downtime, whatever on the validator. And also if we, spike the fees up, try to do a fee rug, then of course we would have, pretty big public markets type problems. So I think a lot of people, some people are staking to the LST because they like that oversight. They like that kind of protection, those kind of guarantees there. But then with the integrations that we've done with Kamino and with many others, you can kind of use it as a full-fledged LST everywhere that LSTs are usable, essentially. So I guess lastly, I'd say we like the LST because we use it ourselves. So some of our corporate treasury is in the LST and we can use DeFi in all the ways that one can use an LST in DeFi. We can also do the same. And so that's part of our strategy, part of why we were excited that Sanctum created DeFi or DFDV SOL is because we can just use it ourselves. So we're kind of right alongside everybody using it. And hopefully other people like it and it's beneficial for them and they want to use it too.
Definitely. It's as you kind of said, it's like mutually beneficial. Obviously we stand to benefit, and then users or holders of it obviously stand to benefit too. But maybe you could dive a little bit more into that. What I mean is, for example, when we announced the Kamino partnership, we said, of course, it unlocks a number of things, but it also, this partnership, it also means that there is this implication of potential SOL per share, so SPS, which is our North Star. The implication is growth for SPS. Maybe you could kind of just help us understand a little bit more about that. Why is it that this LST is helping us grow this key performance metric of ours?
Yeah, great point. So I'd say, let's call it 2.5 ways. So way number one is, as I mentioned, we can use it ourselves. So to the extent that we can increase yield on our SOL without taking price risk. So, Mark mentioned stake looping or their multiply product. We can do that as well. To the extent that we can increase the staking yield that we're collecting off of our overall SOL balances, that is certainly accretive to SOL per share. So we can grow SOL per share faster by being able to do these things on chain. So that's one. Number two is we do generate a little bit of fee revenue from the LST. Nothing crazy. It's 20 basis points on the asset fee. So if it gets larger, then, great. We're collecting that little bit of revenue. And then, of course, the LST is also staked to our validator. And so that does help grow the stake on the validator, and we generate the validator profits there. So that's, I'd say, point two is the LST fee and then the extra validator stake. Point half, I guess, if you will, is this allows us to put our capital to work on chain. So, we can, we could just buy SOL and stake it via, a BitGo account or a Kraken account or whatever. But it's not really I guess it helps the price when we're buying SOL, but it doesn't really help the ecosystem, right? It's just SOL sitting there, whatever. I guess it's doing validation, so or supporting consensus, which is fine. But if we can interact on chain, we can lend out, DFDV. We can basically get, liquid SOL out into the market. We can put our balance sheet to work on chain to improve liquidity, help with, driving volume, all these things. This is helpful for the ecosystem. And when Solana wins, we all win, but also DFDV wins, right? We want Solana to be going up. And so it's I guess a less tangible benefit, less direct benefit, but still certainly a benefit that we can support the overall ecosystem by putting our balance sheet to work on chain and just generally helping to raise the tide that rises all boats.
Totally. And just to I guess round this out, as it relates to DFDV SOL, what it means for us, from a public company perspective, what would you say it means to earn DeFi native cash flows? I think that's a new concept for a lot of equity market investors and kind of a new phenomenon. So can you help unpack that?
Yeah. So, I think MicroStrategy and Saylor kind of blazed phase one of the trail, and that is just getting your balance sheet denominated in a digital native asset, right? Bitcoin, so that the balance sheet is fluctuating, and people need to model a balance sheet that's not in cash; it's in something else. But we're taking that a step further, and we have a revenue stream that is effectively entirely denominated in SOL. And so what this means is an investor can look at our revenue, look at maybe a revenue projection or forecast, or come to their own conclusion, whatever. And they can be like, all right, well, this is great. Revenue is going to be X. But what happens if the price of SOL doubles? Well, guess what? Our revenue is probably going to, closely double, right? And so, there's some deviance there. It might go up a little bit more, it might go up a little bit less due to what's happening on chain and, some of the network dynamics. But generally speaking, our revenue is highly, highly correlated to the price of SOL. And so now when you're coming up with a revenue projection, you're like, all right, well, we think their revenue is going to grow based on, organic methods. But then also there's this tailwind of the price of Solana. And so if in 5 years the price of Solana is up 10x, then, gosh darn it, our revenue better be up more than 10x in a dollar, dollar denominated terms, because hopefully we're doing, things to grow our revenue, organically, in addition to having this massive tailwind of Solana. And so I think it's going to force TradFi, whether that's sell side, research analysts or the buy side, to start adjusting their models, right? I mean, Saylor famously says Bitcoin breaks all the models. Well, I think Solana further breaks all the models. Maybe that they finally figured out how to fix them with Bitcoin, and now they're broken again because now revenue has to be denominated in something else. And so, our hope is, and one of our goals here is to really continue blazing the trail for even others to follow. So our hope is that we can make it somewhat more commonplace to denominate revenue in, say, Solana, such that the next guy that comes along and wants to do some kind of vehicle, whether it's a treasury strategy or more of an operating company play in a different asset, can, or even the same asset, can have a little bit of an easier time and have some kind of guidance to go by, some standards, some examples to reference, that kind of thing. So we do feel like we're really blazing a trail here with our auditors, with legal, with the regulators, in lots of different ways. And hopefully it just makes it easier for others, especially in other assets, to kind of follow in our footsteps.
Totally. Obviously, I'm biased. I think it's like super interesting, and it's cool to be very much in many ways the first to be kind of doing what we're doing. And of course, I think we're forever grateful for teams to have built out protocols to enable this to happen, such as Kamino. So, hats off to them, and all the other builders in crypto. Cool. I think that's enough on the DFDV SOL front, though. I'm sure Parker could go on and on forever about it. But maybe it makes sense to shift gears a little here and zoom out, and maybe kind of focus on like the future of DeFi lending. So, Mark, there's a lot of skepticism around crypto lending, particularly after blowups of 2022. I don't need to throw out the names. I'm sure we're all scarred and we know them like the back of our hand. But maybe you can just give us kind of your take on like what do you think has changed in this new era of on-chain lending?
Yeah, well, thankfully the scars are generally not from the DeFi setups, because what really was one of the big topics of the last cycle was this transparency and really like the CeFi lending setup, but for digital assets. So it's the Celsius of the world which suffered. And although Kamino Lend wasn't really born then, I mean the Aves of the world, where you've got everything in a smart contract, on chain, transparent. You can see the collateral backing the loans. That just ticked along nicely in most cases. So that's a proven model, and that's what we've been building on really with the DeFi protocol of Kamino. So it's keeping things transparent and on-chain, learning and applying sensible risk management to digital assets, and keep doing more of the same.
Yeah, I kind of want to jump in there a little bit. What I see Kamino as is really the like base layer protocol for lending. And so what I mean by that is like you could see a scenario where banks, like direct to consumer banks, could spin up, and maybe they want to offer unsecured loans to individuals. They know some people in their community, maybe they have a credit score system, whatever. Or maybe they want to offer secured loans against like physical goods, like a car or whatever, house.
Yeah.
But you need a place to source capital.
Yeah.
And so fundamentally, like it creates this base layer mechanism for the entire world to coordinate on borrowing and lending. And today in TradFi, that is like, I guess it's kind of the Fed, but it's also like all of these bilateral and tri-party agreements between all the money center banks. And like, that's what broke in 2008. The whole thing fell apart. And so then it was essentially co-opted by the government. And now effectively the government controls the base layer. And that's created all the problems that we've seen.
Yeah, good points. Yeah, and how we can bring that back to DeFi, right, is this base layer is one thing that we've been cultivating with what was called Kamino V2. So we've brought in lending vaults, right, which is pools of capital from lenders, which can be deployed to fund borrowing activity with different risk profiles. And then that's played out in various marketplaces on Kamino. So take an example, we've got a marketplace for Fartcoin and dollars. So if you as a lender want to earn higher yield, then you can actually lend to holders of Fartcoin to take loans. Now, do you want that mixed up with the borrowers? Let's say you have a grade A rated tokenized credit fund earning 8-9%, and you want to take loans on that, or you want to, as a lender, underwrite that. You don't want to be underwriting the same risk as lending against Fartcoin as a nice tokenized fund. So we segment those marketplaces, but then we have base layer liquidity, often or generally, which are curated by third parties according to a certain strategy that funds all this different stuff. And that's something that I'm really excited about. It's just been getting going. I think we've had this out for 2 weeks. There's about 50-something million deployed in them already. And yeah, this is exactly feeding into what you were talking about there.
Yeah, and I guess some, kind of maybe anecdotal evidence is like, we look at potentially borrowing SOL, potentially lending SOL, and if you look at the rates that centralized players like say a BitGo or a Kraken, any of these big OTC desks, the rates are always worse on both sides than DeFi. So if you're like, you want to lend dollars or you want to lend SOL, especially on a fully secured, collateralized, non-rehypothecated basis, like it can't be beat. You're going to get the highest rates in DeFi, second to none, for the same risk profile, actually lower risk profile. And then on the borrow, you're going to pay more with any of these centralized players than you are just borrowing straight from the quote base layer, Kamino.
Yeah.
Right? And so, I think it is a really powerful thing. The last bear market was basically a credit blow up, right? I mean, FTX, that was fundamentally credit based. Everything was credit based. But these DeFi platforms, they all made it. I mean, there wasn't, I don't know. I guess maybe some of us were on Mango or something, but, like fundamentally all the lending markets made it, and they held up really well. And so I think it's become clear that has to be the base layer for finance going forward, not these, bilateral and tri-party agreements, which is how TradFi and CeFi exist today.
Yeah, exactly. And the models are proven, and obviously there's speed bumps along the way. You've got players who come in and try and execute on the models, but then they screw something up with bad coding practices or bad security practices of not being audited, and then they can suffer losses for users of which we see around in the ecosystem even till now. But broadly, the models work, and this like trusting the code, as you said, has just ticked along smoothly. So I hope, definitely DeFi's evolving now. There's bigger players coming in. There's regulation coming in. So our hope is that all this good stuff that's been done in terms of learning how to build smart contracts and learning how to run DeFi protocols with crypto native assets is going to continue, because it's really powerful, and actually it takes away a lot of that blow up risk of the like the counterparty risk, which we've seen over the past years and lifetimes.
Agreed.
Lots of good discussion there, and just following up again on the risk front. So, Mark, I know we're kind of coming up on time here, but would love to dive in. Kamino is clearly aiming to bring risk managed, capital efficient primitives to Solana. Maybe you mind talking a little bit like what's the long term vision here? For example, are we going to see structured credit or more sophisticated lending markets on chain? Love to learn a little bit more on that front.
Yeah, I think the future's continuing to iterate on the models, right? Like we're seeing like problems or challenges with scaling, more types of users coming in, and then that's influencing the product roadmap. But broadly, it's then expanding the offerings and adjusting risk management for all these new types of asset. So as we said, we've matured from the very crypto native assets, just like meme coins and so on, through to highly credible crypto native assets like your DePIN type tokens, and then the tokenized version of off-chain assets. So continuing to support those and to grow as those kind of assets grow on chain. The other area I'm quite excited about is this hybrid, let's call it off-chain yield brought on-chain. That's being done in different ways. One is like tokenization of TradFi funds. The other one is, let's call it like, bringing private credit or private equity exposure on chain in different ways. Otherwise, just bringing DeFi versions of, rather than crypto Ponzi yield, is actually profitable businesses which DeFi and crypto can add to their distribution. We've got one just launched on Solana called Onre, ONRE. I think it's ONRE.finance is the website, which is doing a tokenized version of reinsurance investments. And that's an example of something that's just not accessible to the man on the street, but is good, solid yield with a fairly respectable risk profile, and then wrapped up in a token made widely available. And yeah, great innovation, and Kamino is trying to be there to build products around these on-chain assets. So future is more of the same, evolving the products and making sure that we can support all these interesting assets.
Makes sense. Yeah, I mean, look, we're all for it. I think both from the standpoint of DFDV as a company, and then of course just individuals with TradFi backgrounds, crypto natives, and have been in the game for quite a while to see all the kind of cool, crazy innovation that's taken place. I do want to. Sorry, yeah, go ahead.
Mark, real quick, you mentioned at the end, you said, just more of the same. Can you just highlight real quick what total TVL on Kamino is now?
Yeah, sure. So, I mean, it depends on what the market's doing on whatever day of the week, right? Because the total assets supplied is heavily weighted by the price of SOL, the price of Bitcoin. So don't quote me on it, because I've been so busy that I've not even looked today at what's going on in the markets. But the total assets supplied, yeah, we've got three in this is in the lending side of things. That's 3.7 billion, and then the open loans is about 1.5 billion. So usually, I mean, what you can call TVL is like the total assets supplied minus the total open loans. So then we have about 2.2 to 2.5 billion. Yeah, indeed. So we're looking at those figures. Obviously, we want to grow the assets supplied, grow the total number of open loans. So that's where we are right now. And
I mean, that's wild. And just maybe for the audience, maybe everyone already knows, this is a bit rhetorical, but like, how long has Kamino been in operation?
Yeah, so we launched the first products, which was these automated trading strategies wrapped up in a tokenized vault. That was in summer to autumn 2022, not long before the whole FTX debacle. And then during 2023, we were building out Kamino Lend, and the TVL then was like single-digit millions. For most of the year, it was less than 5 million. So bringing out Kamino Lend at the end of 2023. Sol starting to have a bit of a rejuvenation, and then over the course of like 18 months, going from a few million to a few billion and beyond has been pretty wild. A few more gray hairs, but it's been a fun journey.
That's incredible. Yeah, I think, the point that I wanted to kind of make was, for a long time, stable coins were kind of just like poo-pooed as boring, right? No one was like,
Yeah.
oh, stable coins are stable, whatever. And then Tether like broke 100 billion and people are like starting to wake up. And then it's just these eye-popping numbers of like, oh, they have more treasuries than like these countries, like a bunch of big countries, right? And so I think candidly, that's going to be, I mean, I know the DeFi summer of 2020, lending protocols were like the big meta, but now they're just kind of like, well, it's kind of boring. They just kind of work, whatever. It's more of the same. But like, I think, maybe this cycle, you'll start to see, I don't know, maybe it's Kamino hit 10 billion in TVL or 20 billion in TVL, and people start to wake up. And then when it breaks 100 billion in TVL, and that happens really fast. That's not like a linear, like, well, they had 1 billion last year, so now they're going to have
exactly
2 this year and 3 next year. It's like it's going to go from 2 to 10 to 100 very quickly. All of a sudden, the guys in finance are all going to be like, "Whoa, this is one of the most interesting metas out there." It's like,
yeah, it's just been cooking for 5 years.
Yeah, and so I'm just like super bullish on what you guys are doing, what Kamino's doing, and I think even the stuff that's like quote unquote not sexy, all of a sudden becomes sexy when you put 100 billion on it. So just very impressed with what you guys have built, Mark, and the rest of the team over there.
Thanks a lot. I mean, likewise, coming at it from different angles, but doing interesting stuff. So it was good to also meet recently, and yeah, looking forward to seeing what more we can do in Solana DeFi.
Definitely. Yeah, I'll second that. Mark, really appreciate you coming on today and chatting with us. And of course, like I said, we're all at DFDV super excited to have partnered with Kamino and continue to explore ways to work together and innovate and be that bridge from TradFi to DeFi, as well as just kind of new and interesting ways for the retail user to come on and play around with the various different kind of products that Kamino has to offer and all that DeFi has to offer. I guess just to close things out, is there anything else that we should know? I know you guys made a pretty big announcement recently as it relates to V2, but anything you want to drop, any alpha leaks, any closing remarks, feel free.
Okay. I mean, I think, as I said, yeah, we've just shipped this V2. I'm just excited about some very cool tokens coming on chain and coming to Kamino, so keep an eye on those. Check out all the interesting stuff you can do, like with DFDV SOL and looping that up for pretty crazy amounts of yield on SOL. So yeah, just watch this space.
Terrific. Well, thanks again for coming on.
Thank you.
For those in the audience, if you're not, feel free to follow Mark and of course follow Kamino and go over there, play around, get your hands on some DFDV SOL if you want. And yeah, we'll catch everyone next time.
Thanks, guys. See ya.
See ya.
Thank you. See you, everyone.